In this module, we will discuss about the trends and reforms undertaken in the indirect taxes in India. Indirect taxes are those taxes wherein the ultimate burden of the tax is not borne by the person on whom it is levied. The impact and incidence of the tax are borne by different entities. It is levied on goods or services rather than on persons or organizations. Nearly all of the activities ranging from manufacturing to those required for final consumption are subject to indirect taxation in India. Activities related to trade, imports, and services are also included in this list. As a result, indirect taxes have an impact on all the business lines in the country. Indirect taxes are governed by a series of tax laws and regulations, which can be a law made by the central government or can even be the state specific laws. Many new acts and laws are being introduced, replacing the old laws and all related issues which have become redundant.
After studying this module, you shall be able to define indirect taxes and their merits and demerits, understand the trends in major indirect taxes in India, understand the reforms undertaken in indirect taxes in India, analyze the reforms undertaken in indirect taxes in India. Indirect taxes are those taxes wherein the ultimate burden of the tax is not borne by the person on whom it is levied. The impact and the incidence of the tax are borne by different entities. It is levied on goods or services rather than on persons or organizations. Nearly all of the activities, ranging from manufacturing to those required for final consumption, are subjected to indirect taxation in India. Major indirect taxes that are levied in India are excise duty, customs duty, service tax. Let us now discuss the merits of indirect tax. Convenient to pay. Indirect taxes are convenient to pay as they are included in prices, hence, taxpayer does not feel the burden directly. Less tax evasion. Indirect taxes are difficult to evade as they are a part of the cost of production and hence included in the prices. Less resentment. Since indirect taxes are hidden in the price of the product, the taxpayer does not realize how much tax he has paid for his total purchases. These taxes are not felt directly and thus cause less resentment. Social value. High indirect taxes on luxuries and prohibitive commodities like alcohol, tobacco, etc., can discourage the consumption of these goods. They can serve to improve equality and public health and thereby boost the welfare of the economy. Greater coverage. In developing countries, only a small proportion of the population pays direct taxes due to low income levels. In such economies, most of the tax revenue is collected in the form of indirect taxes as they have a wider reach. Thus, indirect taxes have a large revenue potential for the government. Forced saving. Indirect taxes take away the consumer's surplus and divert the proceeds to the government. This helps to promote capital formation, promotes economic development. Indirect taxes can be used to promote the production of necessities and discourage the production and consumption of luxuries. Now we will discuss the demerits of indirect taxes, equity implications. Indirect taxes are unjust and inequitable as they are regressive in nature, less economical. The cost of collection of indirect taxes is high as it is calculated and collected at various stages of production and consumption. Unproductive, a substantial amount of indirect taxes is paid by the government to itself as public expenditures and do not lead to any real revenue generation. Inflationary, indirect taxes are passed on to the consumers through increase in the price of commodities. This leads to inflationary tendencies in the economy. Discourage savings. Indirect taxes discourage savings when people have to spend more with a rise in the indirect tax rates. Let us now discuss the trends of indirect taxes over the years. The tax structure at central level revolved around indirect taxes in the 80s. Almost 80% of the tax revenue was generated through indirect taxes. As a percentage of GDP, indirect taxes had increased from 4.99% in 1980-81 to 6.15% in 1990-91. The share of indirect taxes in total taxes had increased from 79.77% to 83.94% during the same period. In the wake of reforms initiated in early 1990s, the share of indirect taxes in total taxes had declined from 83.94% in 1990-91 to 63.67% in 2000-2001 and then further down to 45.39% in 2010-11. The reforms were focused on improving the share of direct taxes. The indirect taxes as a percentage of GDP has also shown a declining trend post reforms. From 6.15% in 1990-91, it fell down to 4.01% in 2000-2001. In 2010-11, it was 3.38%. Excise duty is one of the most well-known forms of taxation in India. Any manufacturer of excisable products is liable to pay this tax. The excise duty is required to be paid before the goods leave the factory. Excise duty is imposed on all excisable goods manufactured or produced in India. The rates of the excise duty vary depending on the nature of commodities. The excise duty rates are notified in the Central Excise Tariff Act but can be revised accordingly by the Annual Finance Acts.
The rates of excise duty vary depending on the nature of commodities. Sometimes, even for the similar commodity, the tax rates are different depending upon the circumstances. Factors like end use and taxability of inputs are responsible for this. The excise duty rates are notified in the Central Excise Tariff Act but can be revised accordingly by the Annual Finance Acts. However, the former acts are considered to determine the applicable excise duty rate for any commodity. The duty is payable by the manufacturer at the time of removal of goods from the factory premises or warehouse. The taxable base is the wholesale price of the goods manufactured. However, to achieve the particular objectives, for example, to promote exports, to avoid multiple taxation, to promote education and research activities, or to encourage the use of specified raw material, it is in the power of the central government to exempt certain excisable goods entirely or any part of the duty leviable on such goods. Most of the products attract excise duties at the rate of 16%. But there are numbers of items that are subject to either a nil or ad valorem rate. Central excise duty is administered by the Central Board of Excise and Customs.
Let us now observe the trends in excise duties over the years. Since 1980-81, there has been a declining trend in excise duty, and this declining trend is truly a matter of concern. The reforms in union excise duties in 1990-91, rather than improving the revenue productivity, have led to its decline over the years. We can see in Table 2, as a percentage of GDP, excise duties decreased from 2.49% to 2.41% in 1990-91 and then further down to 2.29% in 2000-2001. In 2010-11, the rate was even lower at 1.44%. As a percentage of total tax collections, this component of revenue has shown a major decline. As a percentage of total taxes, it was 39.78% in 1980-81, falling down to 36.41% in 2000-2001, and then it fell down to 19.29% in 2010-11. The share of union excise duties witnessed a sharp decline of over 31 percentage points. The sharp decline in the share of union excise duties was largely on account of rate cuts and in recent years on account of the slowdown in the growth of the manufacturing sector. Now we will discuss custom duties. The Constitution has given to the Union a right to legislate and collect duties on goods imported into or exported from India. The Customs Act 1962 is the basic statute effective from 1st February 1963. The categories of items and the rates of duties which are leviable have been specified in two schedules to the Customs Tariff Act 1975. Customs duty is calculated on the transaction value of the goods. Currently, the customs duty rates vary from 10 to 60%, and they are either ad valorem, specific, or a combination of both. Very few items are subject to customs duties on their export.
The Customs Act 1962 is the basic statute effective from 1st February 1963. The categories of items and the rates of duties which are leviable have been specified in two schedules to the Customs Tariff Act 1975. The first schedule specifies the various categories of import items in accordance with the International Scheme of Classification of Internationally Traded Goods, harmonized system of nomenclature established by the World Customs Organization. All goods are classified into categories called headings and subheadings. For each subheading, a specific rate of duty is prescribed. The Act extends to the whole of India except the state of Jammu and Kashmir. The levy and the rate of customs duty in India are governed by the Customs Act 1962 and the Customs Tariff Act 1975. The customs duty is calculated on the transaction value of the goods. Custom duties in India are administered by the Central Board of Excise and Customs under the Ministry of Finance. The rates of custom duties for goods imported from countries with whom India has entered into free trade agreements such as Thailand, Sri Lanka, BIMSTEC, South Asian countries and Mercosur countries are provided by Central Board of Excise and Customs.
The most important and in many ways far reaching reforms have been in the case of customs tariffs. The fastest growth of revenues was in respect of customs during the period from 1980-81 to 1990-91, when import duties were significantly reduced. In 1980-81, the customs revenue was 36.43% of the total tax revenue and went up to 48.03% in 1990-91. Since 1992-93, that is post-liberalization, a sharp fall is noticeable due to drastic reductions in tariff rates. Imports subject to quantitative restrictions constituted 90% of total imports, and these restrictions have been virtually done away with. Due to these reforms, the revenue has been falling and it came down to 25% in 2000-2001 and further down to 17.08% in 2010-11. Customs revenue as a percentage of GDP has increased from 2.28% in 1980-81 to 3.52% in 1990-91. Post reforms, this ratio has been falling and had reached 1.58% in 2000-2001. In 2010-11, the ratio was 1.27%. Service tax was introduced in India for the first time in 1994. Service tax is levied on specified taxable services, and the responsibility of payment of the tax is cast on the service provider. Any person providing the taxable service is required to charge service tax from his client and pay it to the government. Initially, the service tax was imposed on the following services: telephone, stockbroker, and general insurance. Over the years, it was extended to other services as advertising agencies and courier agencies.
Service tax was introduced in India for the first time in 1994. It extends to the whole of India except the state of Jammu and Kashmir. It is levied, collected, and appropriated by the Union Government. Service tax is levied on specified taxable services, and the responsibility of the payment of the tax is cast on the service provider. Any person providing the taxable service is required to charge service tax from his client and pay it to the government. However, in some of the cases, the receiver of the service has been made responsible for paying the service tax to the government. The Finance Act 2001 introduced self-assessment for service tax returns, which are expected to be filled half yearly and by the 25th of the month following the half year. This is in replacement of the monthly or quarterly returns prescribed earlier. Initially, the service tax was imposed on the following services such as telephone, stockbroker, and general insurance. Over the years, it was extended to other services as advertising agencies and courier agencies. At present, over 100 services mentioned in clause 105 of the section 65 of the Finance Act 1994 are liable to service tax. Further, section 93 subsection 1 of the Finance Act 1994 empowers the central government to grant exemptions from payment of service tax. In exercise of these powers, the central government has granted partial or full exemption to certain services. For example, in 2011-12 budget, certain exemptions were extended, like exemption provided to services rendered in relation to business exhibitions held abroad, an abatement of 25% from the taxable value provided for the purpose of levy of service tax under transport of goods through coastal and inland shipping, exemption provided to works contract service rendered for construction or finishing of new residential complexes under the Jawaharlal Nehru National Urban Renewal Mission and Rajiv Awas Yojana, exemption provided to services rendered within a port or other port or an airport under works contract service for specified areas, exemption provided to Rashtriya Swasthya Bima Yojana under the general insurance services, etc.
The service tax collections have shown a steady rise since its inception in 1994. The tax collections have grown manifold since 1994-95, that is, from Rs 407 crores in 1994-95 to Rs 71,016 crores in 2011-12. The total number of taxable services has also increased from 3 in 1994 to 119 as on 1st May 2011. There is a substantial increase in number of assessees and taxable services, but their growth rates have not consistently increased so far. In short, the service tax is progressing faster in terms of revenue generation from taxable services, assessee base, and even service tax collection per assessee and per service. Although the average contribution of service sector in GDP of the country has increased from 41% in 1980-81 to nearly 55% at present, the average contribution of service tax in the total tax revenue and its average percentage to GDP both are very small, that is 0.93% and 12.77% respectively in 2011-12.
Service tax is growing very fast in terms of revenue, but its amount of revenue is much lower than the other major taxes of the central government. Although the average contribution of service sector in the GDP of the country has increased from 41% in 1980-81 to nearly 55% at present, the average contribution of service tax in total tax revenue and its average percentage to GDP both are very small, that is 0.93% and 12.77% respectively in 2011-12. In short, the service tax is generating much lower revenue from the service sector and contributing small percentage to total tax revenue of the country.
Now we will discuss the reforms undertaken in indirect taxes. The excise duty structure in the beginning of the 80s was complicated and also had a major cascading effect. To curb that, the modified value added tax (mod VAT) was introduced in a phased manner from 1986. By the middle of the 80s, the customs tariff rates were extremely high and the structure complex. The import tariff rates have been reduced from 72% in 1990 to 15% at present. The peak rate of import duty too has been brought down from over 150% in 1991 to less than 20% at present. Service tax was introduced in 1994-95 in line with the recommendations of the Chelia Committee. The budget of 2011-12 aimed at adoption of major new tax legislations, the Direct Tax Code. The proposed goods and service tax is a part of the tax reforms that focuses on evolving an efficient and harmonized consumption tax system in the country. Goods and services tax is supposed to replace VAT.
Let us now discuss the reforms undertaken in indirect taxes in detail. The excise duty structure in the beginning of the 80s was complicated and also had a major cascading effect. To curb that, the modified value added tax, that is MODVAT, was introduced in a phased manner from 1986. MODVAT credit system, starting with a few commodities, was expanded to cover most commodities and provide a comprehensive credit system by 1996-97. In 1999 and 2000, almost 11 tax rates were merged into three, with a handful of luxury items subject to two non-rebatable additional rates, that is 6 and 16%. These were further merged into single rate in 2000 and 2001 to be called a central VAT, that is CENVAT. Besides reduction in the number of rates, the tax has been progressively converted from specific duties into ad valorem levy. By the middle of the 80s, the customs tariff rates were extremely high and the structure complex. The long-term fiscal policy presented in the Parliament in 1984-85 emphasized the need to reduce tariffs, have fewer rates and greater uniformity, and reduce and eventually eliminate quantitative restrictions on imports. However, for reasons of revenue, the tariffs were raised. Thus, by 1990-91, the tariff structures remained highly complex, varying from 0 to 400%, and over 10% of imports were subject to more than 120% of duties. Import tariffs have been reduced from 72% in 1990 to 15% at present. The peak rates of import duty too has been brought down from over 150% in 1991 to less than 20% at present. Service tax was introduced in 1994-95 in line with the recommendations of the Chalia Committee, with three services, namely non-life insurance, stock brokerage and telecommunications. The list was expanded in succeeding years to include 119 services at present. The rate imposed originally was a moderate 5% of turnover and has been retained rate at a uniform rate of 10% on the value of taxable service, with 2% education cess and 1% secondary and higher education cess on the amount of tax payable, making the total service tax payable to be 10.36% in 2011-12. The budget of 2011-12 aimed at adoption of major new tax legislations: the Direct Tax Code for direct taxes and goods and service tax in the case of indirect taxes. The proposed goods and service tax is a part of the tax reforms that focuses on evolving an efficient and harmonized consumption tax system in the country. Goods and services tax is supposed to replace value added tax. Let us now recapitulate what we have learnt in this module. In the year 1980-81, indirect taxes accounted for 79.77% of the total tax revenues collected by the central government. By 1991, this share had increased to 84%. Customs as a proportion of the total tax revenue increased from 36.43% in 1980-81 to almost 48% in 1990-91, and the excise showed a decrease from nearly 40% to 32.81% during the same period. The increase in the customs revenue outweighed the decrease in the excise revenue, resulting in an increase in indirect taxes in the 80s. The Tax Reforms Committee of Chalia Group recommended an introduction of the service tax to widen the tax base. Service tax was introduced in 1994-95 with three services, namely non-life insurance, stock brokerage and telecommunications. The list was expanded in succeeding years to include 119 services at present. In case of excise duties, the MODVAT credit system, which was evolved in the 80s, starting with a few commodities, was expanded to cover most commodities and provide a comprehensive credit system by 1996-97. In the case of import duties, there has been a drastic reduction in both the average and the peak tariff rates. In 1990-91, the peak rate was 355% and was reduced gradually to 15% in 2005-6. Because of these reforms, the share of indirect taxes in the total tax revenue went down dramatically to nearly 64% in 2000-2001 and then further down to 45% in 2010-11. The indirect taxes as a percentage of the GDP has also shown a declining trend post reforms. From 6.15% in 1990-91, it fell down to nearly 4% in 2000 and 2001. In 2010-11, it was 3.38%. Excise revenue improved slightly in the 90s, going up to nearly 36% in 2000 and 2001, and then it went down to 19.29% in 2010-11. Customs decreased throughout, falling to 25% in 2000-2001 to 17.08% in 2010-11. The share of revenue from service tax went up from 1.91% in 2000-2001 to 12% in 2010-11. However, this could not compensate for the decrease in the share of the other two